Welcome to the Q3 and 9 months FY22 earnings conference call of NOCIL Limited. This conference call may contain forward-looking statements about the company, which are based on the beliefs, opinions, and expectations of the company as on date of this call. These statements are not the guarantees of future performance and involve risk and uncertainties that are difficult to predict. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. S.R. Deo, Managing Director of NOCIL Limited. Thank you, and over to you, sir.
Thanks a lot. Good morning and very warm welcome to everyone present on the call. Along with me, I have Mr. P. Srinivasan, our CFO, and SGA, our Investor Relations Advisors. Hope you all have received our investor presentation by now. For those who have not, you can view them on the stock exchanges and company website. I hope you and your loved ones are safe and doing well in the current challenging times. In our yesterday's board meeting, board has decided to appoint Mr. Anand V.S. as Deputy Managing Director. I would like to welcome Mr. Anand on the board of the company. Just to give you a background, Mr. Anand is a chemical engineer with postgraduate diploma in management from MDI Gurgaon. Prior to joining NOCIL, Mr. Anand was Managing Director of Shematol, a BASF company. Mr. Anand was associated with BASF from 1997 till date. He has over two decades of diverse experience in chemical industry. He will be joining the company in first week of March. This appointment is in line with our long-term strategy planning for the company. I thought that I need to share this first before I touch upon the Q3 results. Now coming to the Q3 results, we achieved an all-time high revenue of rupees 389 crores in Q3 FY22 on the back of improved realization by 3% and marginal volume growth of 1% compared to the previous quarter. As a result of the global inflationary trend and a sharp rise in commodity prices, the prices of our key raw materials and fuel have risen sharply. This unprecedented rise in raw materials, freight and other input costs continue to put pressure on our margins. Our company is committed to improving operational efficiencies on a regular basis and to always keeping costs under control. We continue to review the situation, and to cover the higher raw material costs, we have increased our selling prices again in Q4 FY22. In the current market environment, where input costs have skyrocketed, it is difficult to forecast margins for the future. I would like to reiterate our expectations of more than 10% volume growth and more than 50% revenue growth in FY22 as compared to FY21, would be achieved during FY22. Coming back to the industry scenario, we believe that Omicron variant has set off a new wave that has potential to disrupt various industries, including tires. The tire industry is relatively better protected from any potential impact of Omicron due to its reliance on stable demand from tire replacement. According to a reputable rating agency, the Indian tire industry is expected to grow at a rate of 13 to 15% in volume for FY22 and 79% for the period of FY22 to FY25. With the increasing acceptance of Indian tires in overseas market, tire exports have increased sharply in the current year, owing to strong demand from destinations such as United States and Europe. The increased outlay in the road sector and infrastructure development augurs well for the tire industry. The tire industry is seeing a revival in capex spending towards capacity addition as the demand outlook remains favorable despite the threat of a third wave of pandemic. Over the next 3 years, the company's proposed cash package is estimated to be more than 20,000 crores. Our new capacity addition aligns with several tailwinds in our business, allowing us to grow our revenues and profitability at a faster rate in the coming years. Our presence in the export market has been improving, and we are very optimistic about our export business. The global consumption of rubber data, both natural and synthetic rubber, continues to show signs of an upward trend. The annualized rubber consumption on the annualized basis based on January to September 2021 period shows a growth of approximately 9.6% compared to a calendar year of 2020, a degrowth of 6%. When we look at our volume growth for calendar year 21% is more than 3x industry volume growth. That's all from my side. Now I would like to hand over to Mr. P. Srinivasan to give you an update on the financial performance. Thank you very much.
Thank you, Mr. Dev. Good morning to everyone. Hope you all are safe and in good health. As Mr. Dev just said, that the quarter ending December 21 of Q3 FY22, we have registered a highest ever quarterly revenues of 389 crores. The performance has been on a sequential basis has been stable on the profitability front. Now let me run through the brief financial highlights. These volumes of Q3 FY22 grew by 36%, taking base of Q1 FY20, whereas in sequential quarter as compared to the Q2 FY22, it's about 1% growth. The net revenue from operations for Q3 FY22 stood at 389 crores as against 375 crores in Q2 FY22, a sequential growth of 4%. The sales growth has been driven by a marginal increase in sales volume and a price hikes taken during the quarter, more specifically for the spot market, which we announced in the previous investor call. Net revenue for the 9 months FY22 stood at 1109 crores rupees as against 603 crores in 9 months FY21, a growth of 80-odd%, 84% to be precise. Coming to the operating EBITDA, the operating EBITDA for Q3 FY22 stood at 50 crores as against 49 crores for a sequential growth of 1%. For 9 months FY22, it is about 172 crores as against 77 crores in the corresponding 9 months period of FY21. EBITDA margins for the quarter stood at 13% for Q3 FY22 as compared to 13% in Q2 FY22. For 9 months, this is at 16% as against 13% in the last year's 9 months period. As stated in the previous call, and EBITDA for this quarter was under pressure, primarily driven by a sudden surge in input costs, energy costs, etc. The profitability aspects, profit before tax for Q3 FY22 stood at 40 crores as compared to 41 crores Q2 FY22. PBT for 9 months, April to December 21, stood at 144 crores as against 62 crores for 9 months FY21. On the profit after tax parameters, the December quarter Q3 FY22 stood at 30 crores as compared to 31 crores in the previous quarter. The profit after tax for 9 months stood at 107 crores as against 50 crores for the 9 months FY21. With this, we would like to open the floor for question answers.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2.
Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Nirav J from Anvil Research. Please go ahead.
Good morning, sir.
Good morning, Nirav.
Yeah. So I have two questions. So one to Mr. Srinivasan and then to Mr. Dev. So, sir, in 3Q FY22, when we see our investor presentation on indexation of volumes, we were at 149 in Q3 FY21, correct? If I see your investor presentation correctly. So at 149 we were in Q4 FY21, my mistake, sir. And currently we are at 136. So when we compare this indexation of 149 to 136, our conversion cost in Q4 FY21 was 92 crores. But with the drop in volumes in Q3 FY22, our conversion cost has gone up to 108. So if you can help us explain where the conversion cost has gone up even with the fall in volumes, some understanding on the same, sir.
Conversion cost, I think post value addition.
Yes. So post value addition, correct.
Okay. You are saying Q4 FY21 is about 92 crores and now it is
108 crores.
108 crores. Yeah. I think basically there are two parameters. When you one is the surge in the freight cost, which is evident in the ocean freight or maritime freight cost, which has gone significantly. This is also compensated by appropriate price rise in the selling prices. Secondly, we also see the energy cost going up significantly because of the way energy prices have moved in the last 2-3 months. So these are the combination of two factors which has taken the cost for about 15-16 crores for the quarter.
Correct. So if you can give us some broad breakup in terms of how much the power cost has gone up from Q4 FY21 to 3Q FY22 and how has been the situation currently?
Power, I think, Nirav, can I come in? I think I can give you a very broad view of the...
Broad, sir, I want a broad understanding only, sir.
Yeah. So
not specific numbers.
Okay. So basically, I think this is all published information on which I would like to share it with you. First thing, if you really look at the cost of coal in April 2021, it was about 5,000 rupees a ton.
Yeah.
It touched as high as 15,000 to 16,000 rupees a ton, with availability becoming an issue. And currently it hovers at about 11,000 to 12,000 rupees a ton. So that's the way the coal cost has gone up. If you really look at the cost of natural gas, which at the beginning of the year was about 32 to 33 rupees per standard cubic meter, it has gone to 66 rupees. Okay. Yeah. So I think this will explain the cost of energy going up for practically everybody. It's not for NOCIL.
But I think you have to see from a revenue perspective, the revenue has also correspondingly gone up. If you look at in absolute terms, in terms of the volume parameters as well as the revenue parameters, it is compensated by an appropriate price hike in the revenue parameters. So despite the conversion cost going up, what we are seeing is this has also shown an increasing trend.
Correct. Because then probably our volumes would have come down. So on a per kg basis, if you see those sort of increases we have seen because of this increase in the power and the freight cost. So I was just trying to understand that where this cost has gone up in the power. So what Mr. Dev has rightly mentioned, that even the natural gas has also played a part in terms of increase in the cost of production. So I was trying to understand that aspect, sir.
Yeah.
Yeah. And sir, second question to Mr. Dev. Sir, in slide number 18, on slide number 18, you have mentioned that our R&D capabilities have led to the significant reduction in the cost of production. And if you can explain this with respect to the product and the process innovation, what we have been doing at NOCIL. And if I can just add one more point, even if we see in last decade, even our intensity of R&D expenditures have gone up. So like from 2-3 crores in 2009-10 to 5-6 crores in 2021. So if you can relate this aspect with the statement made on the slide number 18, that would be helpful.
Okay, Nirav. I think I would not like to share a very specific information in terms of what technological changes which we have done in the processes. But I can give you a broad guideline. In our research center, there is one group which continuously keeps on looking at the process efficiencies. The process efficiencies include 2 or 3 aspects. First thing, it includes the consumption of raw material and how we can keep on optimizing the consumption of raw material. The second aspect which is being seen is, can we keep on adding creeping capacities in the same hardware by making some minor process changes. And this yields a lot of significant reduction in the cost of production. Okay. And this is what we call it as a continual improvement in technology in terms of products and processes. Of course, there is one more aspect which more is in terms of marketing side, that is the quality of the product. Because as far as we are concerned, since we are in a global market, we continuously keep on benchmarking our quality, and our research center keeps on looking at how we can be number one in quality and keep on changing the process changes. So these are the aspects which we handle in our R&D. Obviously, what you are saying is right. Our R&D expenses have gone up because when we start building up these capacities, we have to bring in hardware, we have to bring in software, and all these things will continue to increase the R&D expenses. But of course, I think those expenses as compared to what benefits we get in terms of our business are much, much higher.
Correct. And sir, if we see going forward, because these expenditures will go up based on the commentary what you give. So would it be more towards developing more products or adding more products to our product basket of 23, or would it be furthermore towards reducing our cost of production? So how our future R&D expenditures would look like?
Nirav, I think it will be multifold. It will not be in one singular direction. So as I told you, this efforts in terms of improving the capabilities, in terms of significant reductions in costs, that's a continuous process, and it will continue to happen. As far as the development of new products, the development of new processes, also extremely high emphasis in terms of effluent treatment and actually developing green technology, that will continue, but it's a long-term perspective. Okay.
Correct.
So both the things are being handled simultaneously in our research center.
Okay. Got my answer, sir. All the best, and I'll jump back in the queue. If I have any further questions.
Thank you, Nirav.
Thank you. The next question is from the line of Shivan MS from JHP Securities. Please go ahead.
Good morning, sir. Am I audible?
Good morning.
Yes, please.
Yes, sir. Sir, a couple of questions. One is you mentioned about the improved traction in the exports market. So if you could give some color on the percentage of exports that we've done in this quarter compared to what we were doing pre-COVID, and how have the realizations been there?
Okay, I'll just give you that. Exports, we have improved from a level of 100 index. I believe we are already in the region of 150, 160, thereabout.
Okay.
On indexation. Secondly, on the pricing parameters, I think that is very evident. One need not do any simple mathematics. If we at 149, we were at 149, what is that index volume of 149, which is what Nirav was referring in the previous question. Q4 149 index was shown as revenue of 270 or 320 crores thereabout. And today at 136 or thereabout, it is already 389. So it speaks for itself. The price corrections have happened, and it has happened not only in Indian market, even in international market. So that I think we have been giving you the guidance all along that the market conditions have changed. The Chinese competition has also started correcting prices from last year onwards, say end of December 20 or early 21 onwards. So that action continues to be in place, and we are also changing in line with those parameters.
So my question on the realizations was, as compared to what we sell in the domestic market, are they better?
These are all international CIF-based prices. Obviously, it will be international equilibrium. You cannot have a disparity in that in one market you get better prices, in another market you get a lower price. No, I think it's more or less constant pricing for the same product, adjusted for duties.
Okay, sir. Got it. And sir, in coming back to the domestic market, sir, could you give some idea on how the imports into India been and our market share over the last few quarters?
See, basically, before pre-COVID, our market share dropped down to as low as 35%. From 35, we have already improved to 42-43% today.
Okay, got it. And sir, regarding the increase in the energy prices, so are we looking at some capex on that front to have in-house power or something of that sort to reduce?
I think Mr. Dev will answer that.
In fact, I think we have already taken a lot of initiatives in terms of having captive power. We already have power generation through steam turbine at Dahej. We also have, I would say, a reasonably good amount of power generation at Dahej through solar. And of course, this we did it much ahead of this power crisis or the power flow. And this has been the strategy of the company. And as we start growing in terms of manufacturing, this strategy would continue.
Got it, sir. Got it. That's it from me. I'll come back in the queue if I have anything. Thank you.
Thank you. The next question is from the line of Rohit Nagraj from Emkay Global. Please go ahead.
Yeah. Good morning, Dev sir and Srini sir. So the first question is on the demand environment. Given that there is a high input cost raw material which is coming in, and in the recent past also we've seen that crude oil prices have now jumped more than $90. So given the historical evidence, maybe sometimes in 2018 when the crude prices were closer to $80-85, how does the demand usually shapes up? Is there any impact on the demand side? And again, given the historical perspective, do we have the ability to continuously pass on the increase in input cost with a lag effect? Thank you.
Okay, I think I would split your question in two parts. First thing is you are talking of demand. Now, let me tell you one thing. If you really look at the core industries like automobile and tire industry, which is all related, except for last 8 or 9 months when there is a crisis of chips availability, this continues to grow in line with GDP of the country. And this you will see it as a historical data. So as far as the demand is concerned, if FY22-23 GDP growth is expected to be somewhere close to 8.6% as estimated by our Honorable Finance Minister, we are very certain that the growth of tire industry would be higher than that, and of course the rubber chemicals. So demand is basically actually the economic indicators of the country. That is one thing. Second thing, as far as the crude oil prices going up is concerned, yes, that's a concern because the overall energy costs are going up, the crude oil prices are going up. Whether we will be able to pass on these inputs to our customers, I would say we are optimistic. Okay, we cannot give a definitive line of action on this. But looking at the markets, looking at the China Plus strategy, and various other economic and political factors, we feel that we should be in a position to pass on the prices to our customers.
Rohit, I would like to add here, if you see the data of last 1 year in the last 4 quarters, and especially from the international competition like China, we have seen China has been correcting its prices in proportionate to the increase in raw material costs. So even they are also feeling the pinch, and they are also responding appropriately.
Right, sir. Got it. That's very helpful. So the second question is on the utilization front. Now, Dev sir mentioned that the tire demand is going to be higher than the GDP growth rate, which seems to signify that volume growth will continue. And as per our continuous guidance that by September 23 we will be able to utilize the expanded capacity or rather full capacity optimally. Any further thoughts on the capex plan? And generally, again, a corollary to this is generally how much time does it take to go in for a brownfield expansion? Because given that the lead time could be 12 to maybe 18 months, we may have to start off with the at least initial part of the capex process in next few months. So just your thoughts on this. Thank you.
Okay, I think first and foremost thing, our earlier guidance that we would be able to achieve our capacity utilization by September 23. We are pretty hopeful that we should be able to achieve the target. Okay, so that guidance remains constant. Now, as far as the capex is concerned, okay, I think of course we continue to plan the capex, but as I was answering Nirav, we also have a huge research capacity where we start looking at a creeping capacity increases through debottlenecking. These are small capexes, but it gives a lot of return. So simultaneously, we will continue to plan a long-term capex, and once it is consolidated, approved by the board, we will share it with you. But as day-to-day work, we continue to work with our research center and continue to increase the creeping capacity if we find that a particular product, the demand is more than what we have estimated. So it's both ways we are working in it, but the objective is very clear. Okay, the objective is we would like to continue to be a strong player in rubber chemicals market.
I'd like to add that we have still an unfinished agenda in the rubber chemical space, and we believe we have enough space to grow there.
Right, sir, got it. So just one small clarification on number. Srini sir, what would be the cash on the books by the end of 9 months FY22?
I don't think so. We normally give that in December 21. We have given already the investor presentation talks about what is there in September.
Sure, sir. No worries. Thank you so much and best of luck, sir.
Thank you.
Thank you. The next question is from the line of Dhaval Shah from Swan Investment. Please go ahead.
Yes. Hello.
Yes, sir.
Yeah, hi, sir. Good morning. Sir, a couple of questions. Sir, firstly, by the time we reach our full utilizations on the capacity side, what sort of gross margin improvement should we see, provided in assuming we are able to pass on almost everything on the raw material inflation? So that's my first question. And on the second question, in terms of how is the business trajectory? You see, how is the recovery on the volume side happening over next 1 to 2 quarters?
Dhaval, we would like to answer twofold. Yeah. We have been giving guidance that ideally in a stable market regime where the input price on the lower end and the finished good price was on the higher end, we were having a 50% target on value addition margin because the level playing field was on the lower end. But when your input cost goes up significantly, and if you see in the last 1 year, it has gone up by almost 60 to 75%. You cannot expect the value addition percentage to be maintained at 50%. So therefore, we have to necessarily look at protecting the value addition margins per kg is what we normally look at. and we can reasonably confidently say that we are in the best place. We are continue to maintain the margins even today. So to that extent, we can assure you that we are maintaining the same level of absolute per kg margin what was being reported in the good old days also. That's number one. Now, coming to the second part, as far as the volume growth is concerned, Mr. Dev just alluded to that when the GDP is expected to grow at 8.5 to 9% growth per annum, and with the tire expansions in place, with the credit rating agency talking about a good tire demand in the next few years, we don't see any harm in placing additional volumes, and we believe our volume growth also will be significant.
Got it. And sir, just one more question. Sir, when we think about the next leg of expansion, will our mix of product be same, or it will be more towards specialty or high margin products than what the current basket is?
I think we would like to clarify here. Whenever we are taking over a specialty application, it depends on the market how it unfolds. So you cannot say that it has to go sequentially. It has to have a specific application and the need for the application. So whenever such a need arises, we will definitely participate in that. So obviously we would endeavor to do more of specialty chemicals. That's anyone's dream. But market conditions also needs to be studied, and depending on the market conditions, we'll decide the mix.
So to put it differently, say for example, you're expanding by 100 ton, for example. So what is the minimum of the basic, the PX13 and the basic chemical we need to have, at any time, as in your capacity?
I think I would prefer to answer in a different way. When the rubber consumption goes up significantly, along with the rubber consumption, your rubber chemicals, conventional rubber chemicals also grows sequentially. Exactly the same pattern. Say for example, if the rubber consumption goes up from 30 million tons to say 35 million tons, which is about 15% growth or 15.5% growth, same means spill flex cutting demand also goes up by 15.5%. There is no direct correlation there. Or the conventional rubber chemicals, spill flex 13, TDQ, such products. Yes. When we talk about specialty applications, these are all specialty applications. So depending on where the applications, where the customer, and depending on their needs, the demand will pick up. So I hope we have clarified to that extent.
Okay, so there would be an element of fungibility, so you can make more of specialty when the demand arises.
Yeah. In our setup, we have dedicated plants. We don't have flexibility in the same plant to have a specialty and a conventional thing. I think that is not a viable solution.
Okay, fine, sir. Thank you.
Thank you. The next question is from the line of Diman Shah from One Up Finance. Please go ahead.
Yeah, good morning. Thank you for the opportunity. Again, delving on the previous questions asked by previous participants. On the expansion, can you just throw some light as to, why would we not have fructified? Is it because by this time you have already, if I understood correctly so far, we have already seeded most of our products, and now we cover all the categories, be it accelerator or specialty or vulcanizers, antioxidants, everything. And possibly we have got acceptance in the export markets where you alluded that, possibly the growth is going to be very vibrant. Then is it that, we will still take only debottlenecking and not the minimum economic size of jump and, kind of again expand maybe by 25, 30, 40% to whatever extent our cash flows do allow?
I think I have explained this to the earlier question. There are always two strategies, because one must understand that what you have rightly said is a minimum economic size of the plant. Now, when you get into minimum economic size of the plant, you also have to look at the utilization, the return on investments, okay. And it takes a longer time. Whereas if you continue to do a debottlenecking, and debottlenecking also has a limit, But if you continue to do it, then I think on a very small capex, your returns are very high. So what we do is we adopt both the strategies. So we continue to do debottlenecking, and since we have put the latest plant, we see some scope and elbow room in terms of debottlenecking those plants. But obviously, we are also planning a long-term capex. And as I said, our capex ideas, looking at the market, because currently you must also understand the markets are very, very volatile, both in terms of supply chain, also demand. And of course, we will continue to work on that. We are working on that. And at an appropriate time, we will share the capex ideas with you.
Great. Just let me rephrase that, sir. Sorry for being persistent.
Yeah.
Suppose these supply chain and, the high oil prices and raw material prices, I mean, basically the volatility does come down or recedes significantly as of today, then what is the capacity that you would possibly envisage?
I think I would not be able to answer this question right now, because we will continue to work on that, and at an appropriate time when we have the right numbers and the right investment propositions, we will definitely share it with you.
Second question is your ability to pass on the price hike. If you take the export market vis-a-vis the domestic market, where do you think you have more ease of pass on, in terms of ability to convince the end customer?
Even I think that question has been answered to the previous participant. Basically, what we are trying to say, this is an international parity prices, and when you have a lead market producer from China participating with 75% market share, he will definitely dictate the price terms on conventional rubber chemicals. And if you are able to match those prices and still make money and make your protection, I think we are reasonably doing a good job. And
sure.
We believe at all the market, whether it is export or domestic, it is always parity prices, obviously adjusted for duties in respect to the consumer markets. But we have to supply before duty at what prices, so that is there, and we have to match it, and we have been matching that only. So there is nothing extra. We have to put an effort to that.
And lastly, on the working capital cycle, can you just give a brief comment? How do you see that come by?
I think we have given a clarification to the investors at large in the previous calls also. Working capital cycle for our business is typically 20 to 25% of your net revenue. So, in other words, if my revenue goes up by, say, 100 crores, you can expect 20 crores getting into working capital cycle, assuming we are not taking any bank finance. That is a business requirement.
Great, sir. Great, sir. Thank you so much.
Thank you.
Thank you. The next question is from the line of Sanjay Satpathy from Ampersand Capital. Please go ahead.
Yeah, hi sir. Thanks a lot for taking my question. Sir, when I look at the volume data that you have given in terms of in your chart, in quarter 3 about 6% decline is there on a year-on-year basis, and the guidance that you have given about 10% growth implies some 30% kind of decline in quarter 4. So how do you really kind of explain this?
I think we did not. We said it will be 10% plus. We never said it is 10% flat.
So, sir, basically,
10% plus. We don't want to specify the numbers. That's for you to guesstimate. But we said it is 10% plus.
Okay, so basically it has no meaning in the sense that we cannot really guess what is going on.
That's it. I mean, we don't want to give specific numbers for obvious reasons. So, but we are given a indicative trend where we are heading for this year. That's all we said.
And the decline that we saw in quarter 3, is that a declining trend which is going to persist, or we are going to see improvement in volume going forward?
See, basically, if you recollect at the beginning of quarter 3, we did announce that we started with this quarter 3 situation with a abnormally high input cost and energy cost. So obviously, certain contracts which we have priced at old prices, we couldn't recover the pricing. But on the spot market, we could pass on. So some customers who could not afford that did not take those volumes. So that's why we consciously participated in volumes where we were able to pass on. In certain volumes, we consciously took a break. So that is one part. Going forward in Q4, we don't see much of a change in volume pattern.
So that contract cancellation, etc., which affected quarter three, so those things are behind us, and it will be back to normal business and normal rubber chemical demand outlook that will decide.
Yes. I think we also clarified in investor call presentation. We said EBITDA margins got affected in quarter three. We gave the reason specifically for quarter three.
Yeah, it is because of this guidance which is really confusing, because if it is so off the mark, then probably it will be better for us not to get any guidance than something which is of little help. Because 30% kind of a decline is like really huge, and it better be explained than being put in a guidance number, particularly when you are talking about 9 months are over and we are talking about that number of...
Where is this 30% decline you are talking about? We are never given a 30% decline. I don't know which one you are referring to.
No, you have given a guidance for the full year of 10%.
I said we have given a guidance of 10% plus.
Over previous year.
Over previous year. We never said it is 10% flat.
10% over previous year.
Okay. I would urge you to really look at this guidance number, because it has to be a little bit more accurate of what is going to happen than being very wild. But I don't want to really labor on this topic a little more. What I have understood from you, you have given this comparison with GDP, etc., to estimate the domestic demand. Which, if I understand you correctly, that about if India's GDP is growing at least 10% next year, then your demand could grow 10%. Is that correct? That is what you said?
Yeah. That is perfect.
And how about export market? How do you kind of estimate what will happen to the export outlook? How will that grow?
It will go as per the international demand, and as we have announced in the past, we have a relationship expanding, and international customers are suggested to NOCIL to expand their service point to various locations, not restrict to one continent. They want global scale. So we continue to do that, and we are in that direction only, in the consolidation phase only.
So my question is that will export continue to grow at a faster rate than in domestic, or it will be something similar?
I think we have already given you guidance in the past that today our export basket out of total revenue is 33-35%. Long term, we are looking at 40% thereabout. So we are in that, proceeding towards that journey.
Understood. And lastly, my question is that because we saw an announcement that you have got a new deputy managing director, and it looks like some management change, and you have also mentioned that you will continue to be in rubber chemical, but will you be able to move beyond automotive sector in a meaningful way?
Mr. Dev will address that.
See, basically, as you see, I think our core competence continues to be rubber chemicals, and we are not only in automotive sector. We also have a very large business in latex sector, okay, and which are entirely different sectors. Okay. So I think this is something which will continue to happen, okay, and that's going to be the growth engine of the company. You must also understand that we have a very large research center, and we also understand chemistry, and chemistry has nothing to do with rubber chemicals. It's chemistry. So we also in future could look at various avenues of exploiting our chemistry knowledge and our market knowledge, maybe to look at different products. But it's too preliminary to share with you. So our core competence on one side in terms of market is obviously the rubber chemicals. But on the other side, the core competence is in terms of developing new products, and these new products could be anything. Okay. So we are looking at the complete basket and our strengths to grow the business.
Understood. So essentially what I wanted to get an understanding is that how the addressable market of NOCIL can expand meaningfully, and we have seen such a massive increase that has happened in your sister concern, that is Navin Fluorine. So I'm just trying to get a sense that how the long-term path that will be started by NOCIL.
I cannot comment on what's happening in Navin Fluorine because I think that's a very different business. But I can tell you one thing: if you really see from last 5-6 years journey of NOCIL invested 450 crores capex to grow in rubber chemicals business. If you really look at our volume increases because of these investments, our volumes have been continuously increasing. If you look at China plus strategies, our exports have been growing. And as we have been saying that this is the business which grows with GDP all over the world. So we see that we have sufficient room to continue to grow in this business. Okay. Obviously, we will continue to grow because that's the business which we know from last 40 years. Okay. But besides that, we will also look at various avenues where we can work with our own strengths, okay, maybe for different products and different markets.
Just to add a bit, Navin Fluorine is no longer a part of the AMG group. This company got separated the group got split in 2016 thereabout. So we are no longer connected with them in any manner.
Thanks a lot, sir.
Thank you. Before we take the next question, a reminder to the participants, please limit your questions to 2 per participant. For any follow-up, may we request you to rejoin the queue. The next question is from the line of Rahul Jain from Credence Wealth. Please go ahead.
Thanks for the opportunity. Sir, given the rated capacity of 1,10,000, we should be currently at around 70-71% utilization. Is that a fair assessment?
Yeah, you can say that, around 70%.
Because quarter 2 also we were around 70%. And maybe this quarter it will be higher by a percent, so 70-71. Is my assessment correct?
Yeah, your assessment is correct.
Sure. So in your earlier replies with regards to the guidance of 100% utilization by September 23, which is about 3 quarters away. So the way I am trying to work out the calculations in the reverse direction, the ballpark figure which I arrive at is to probably in next 3 quarters to reach that 100% utilization. And I'm assuming at 100% utilization, we are talking about the entire utilization of almost 1,10,000. So we are talking about roughly 9-10% volume growth, or other way put it, the total volume growth somewhere at the end of the September, your volume production should be around 35-40% higher than what it is today. Is my understanding correct on this?
I think, we are talking about 7 quarters from now. We are not talking about 3 quarters.
Oh, I'm so sorry.
We are talking about September 23. So that's the first correction we would like to clarify.
Okay. Sorry. So I made a mistake over there. I'm so sorry about this.
No, not an issue. I just wanted to give you a clarification. This is January 22. We are talking about September 23, so we have over 21 months away thereabout. So it's about 7 quarters.
So I'm so sorry about it.
No, not an issue at all. No problem.
Somewhere I think I made the mistake of a year. That's wrong on my part. And sir, with regards to the demand side on the export, are we adding still some new customers or within the customer set, are we getting some increased contracts? The size of the business is growing within the existing customers. How is the export market panning out now, sir, for you?
It's a combination of both. We are expanding in existing customers and we are also adding new customers.
Okay. Sure, sir. Thank you so much. Thanks.
Thank you. Thank you.
Thank you. The next question is from the line of Nilesh Dhoot from Prabhudas Lilladher. Please go ahead.
Yeah, good morning, gentlemen. Thank you for the opportunity. So just wanted to know what percentage of our total 110,000 MTPA capacity is for manufacturing intermediates, that is for captive usage.
I think that we have already been given guidance. It's about 1/3.
Okay. So my next question is basically, I'm sure even Chinese players are aware that, customers are increasingly looking to diversify their sourcing to vendors outside of China, especially after the pandemic. So then why are, Chinese players like China Sunshine adding so much capacity? So, they have added around, they are adding around 50% of their FY20 base, with some capacities already commissioned and the balance to be done over the next couple of years. So how should one, view this? Is it there, is it like there's some kind of an industry consolidation or any existing players shutting down? Or is it like, the demand prospects are anticipated to improve very significantly? Because, if you see global rubber consumption, it should be growing at only around 2-3% per annum. So your thoughts on this, please. Thank you.
When we conceived the expansion plan, we had given a clarification in the past. Basically, when we conceived the expansion plan, we were conscious of the fact that the demand is going to be expanded and China will continue to expand there, and we had factored China participating as high as 70%. So we are not perturbed by that, and it is part of that strategy only. So when you anticipate the competitor is going to expand, then the plans are in place. So we created a plan assuming the competition is also going to expand. What we are trying to say is that what is the incremental demand, our supply, additional supply, accounting for how much incremental demand or how much market share. So we calculated something like 15%. So we were not even looking at big numbers. So that being the case, we are reasonably confident of getting all those numbers without any difficulty. And we believe that's the reason Mr. Dev has been saying that we still have unfinished agenda in rubber chemicals expansion. China Sunshine is only accelerators. And second thing is the competitor which you are referring to. These are players who are in a specific field of rubber chemicals, not in the entire spectrum of rubber chemicals. Say, for example, China Sunshine is primarily an accelerator player. He is not in the complete antioxidant business or in a significant manner. Whereas NOCIL is coming in a complete integrated complex where one-stop shop to the entire customers.
Sure, that's helpful. So one final question, sir. So what is the current status on the anti-dumping duties? Are we enjoying any kind of protection currently, and anything expected in the near future, and any quantifiable benefits from the same?
So I think we already announced in the past that Wilflex 13, we got an anti-dumping recommendation from the DGTR, but unfortunately the central government did not accept the recommendation, so we did not get any benefit out of that. Secondly, we have 3 other products which are under investigation with DGTR, which the final results are awaited in the next, shortly, maybe in a quarter or thereabout. So as of now,
okay.
No benefits accrued to the financials for business.
All right. So one final thing, if I may. So what will be the maintenance capex going forward? So for FY23-24, what kind of maintenance capex numbers should be considered?
It is not more than 15 crores.
All right. Okay. Thank you so much, sir.
Thank you.
Thank you. The next question is from the line of Dhaval Shah from Swan Investment. Please go ahead. So Dhaval Shah, your line is in talk mode. Please go ahead with your question, please.
Yeah, sorry, I was on mute. Yeah, sir, one follow-up question on the capex. In our interaction with few companies, they mentioned that they are currently watching the Winter Olympics and how China's policy towards pollution pans out over next 3-4 months, and then they would think of get some expansion plan. So are we also thinking on the similar line and then for our expansion?
it is not appropriate level to share what we are thinking and how to share, because I said this is a public forum. So please give us some respect, some confidentiality, please.
Okay, fine. That's all I had. Thank you.
Thank you. The next question is from the line of Ravi Mehta from Deep Financial. Please go ahead.
Yeah, hi. Thanks for the opportunity. Just one small question on the specialty chemical side. So I believe the mix has improved over years from 12% to 25% in our sales. What I understand, this is more of non-tire application, as you also shared a while ago in the call. So are these applications, I wanted to know, where are we in this market? Are we as strong as we are in the tire market, or, we see a lot of scope to grow this part of the business?
To clarify, one, it is not only non-tire application. It is a specified high-performance tire applications as well as certain non-tire sectors, latest applications. It's a combination of 2-3 segments in specialty chemicals. In the global scheme of things, this particular product components, overall rubber chemical is not even 10%, whereas we are already in the region of 25% plus. So just to give a perspective, we are much ahead of the global standards or parameters. So, and we intend to maintain this percentage, if not improve. So if there is a scope to improve further, we will definitely go for it.
Sure. That's helpful. And also one follow-up to this is, with a lot of innovations in the tires itself, kind of, heavy duty tires and stuff like that. So are these special chemicals what you make, does it has higher application in the same tires, or how is the trend, if you can, highlight on this, just to get a sense on, how this piece is moving?
They will answer that.
See, I can only say one thing. Yes, I think what you are saying is tire industry is going through a transformation in terms of EVs and the requirement of EVs of future. Now, whether the specialty application will increase or not, we still need to watch. And I think as the EV tire market starts growing, we will be able to comment on that. But one thing I can say that whether it's a traditional tires or whether it is the new EV tires with new dimensions, all the tires will require rubber chemicals. Okay. So rubber chemicals market is completely secured. Whether the specialty markets will grow, I think maybe as this segment starts growing, we will be able to comment only when the segment grows.
Sure. Okay. Thank you. Good luck.
Thank you.
Thank you. The next question is from the line of Bhargav Buddhadev from Kotak. Please go ahead.
Yeah, good morning, team, and thanks for the opportunity. My first question is that given this raw material inflationary situation, are you seeing any channel destocking at your customer end, that they have reduced inventory significantly?
Yes, can you repeat the question? We were not able to clearly follow.
So given that realizations have increased in high double digits this year, have you seen inventory levels of your customers reduce because of this high pricing scenario? So assuming your customers who are maintaining...
We don't have right now exactly, because no customer will share exactly their internal details. But we have to judge, and we judge based on interactions. We try to take a call.
Okay, understood. Secondly, is it possible to share within exports how much is the share from the US market and how much has that business grown in the last couple of years?
I think you can just say from an index parameters, US has gone from 100, which started. If I say 100, then it has already touched 300.
So this 100 was 2 years back?
3 years ago, 2018-19, we started with 100. Now, or maybe 19 thereabout, and we are already at 300.
Okay, sir. Thank you very much, and all the best.
Yes.
Thank you. Ladies and gentlemen, due to time constraint, we take that as the last question. I now hand the conference over to the management for their closing comments. Over to you, sir.
I take this opportunity to thank everyone for joining the call. I hope we have been able to address all your queries. For any further information, kindly get in touch with Mr. Srinivasan, myself, or our strategic growth advisors or our investor relations advisor. Request all of you to be safe under the given circumstances. Enjoy your weekend. Thank you very much.
Thank you.
Thank you. Ladies and gentlemen, on behalf of NOCIL Limited, that concludes this conference. We thank you all for joining us, and you may now disconnect your lines.